So as more and more brokers start offering $0 commission trades, it's going to attract a lot more investors into the stock market. And the first thing they're going to ask is, where should I put my money and what should I invest in? If this sounds like you, or maybe it's someone that you know, either way you want to pay attention to this video because I will be going over the best investment vehicle for 2020 when it comes to index funds and investing in the S&P 500. It's an offering from Vanguard. It's, in my opinion, the best choice out there if you're looking for an ETF. And I'm going to go over the reasons why I believe this is the case. If you want to see more ETF or index funds or Vanguard related videos, make sure to drop a huge like down below. Let's try to get 250 likes on this video. So I know it can be very confusing and very intimidating to really go and choose an ETF or index fund to put your hard-earned money into. And I believe it should be that way because we should be making informed decisions on where we're putting our money into. This is because making the wrong investment decisions now when you're young, in the early stages of your life, will actually come back to haunt you and have a significant impact on your entire life later on when you plan to retire and actually use that investment money. So like I said, this product from Vanguard, this ETF index fund, whatever you want to call it, is going to be the best option for majority of investors out there who are not comfortable with things like stock picking. And I completely stand behind this product because I personally believe that this is the best way for any new investor to invest in the stock market. So the investment vehicle we're going to be talking about today is the classic VOO from Vanguard, the Vanguard 500 Index Fund. And we're going to be talking about 3 reasons as to why I believe this is the best option out there. So the first reason here is broad market exposure. So this ETF contains 508 companies, meaning that if you invest in VOO, you're actually gaining exposure to 508 of the largest companies here in America. And within these companies, you're going to be diversified in many different sectors as well. Here you can see a breakdown of all the different sectors you gain exposure to by holding VOO, and you will notice that it is fairly distributed. IT or tech makes up around 22% of the portfolio, which is expected because some of the largest companies in the world are tech-based companies. However, here you can see you also have a good weighting with healthcare, financials, and even consumer-based stocks, giving you an all-round well-diversified portfolio. This breakdown, in my opinion, gives you a pretty good opportunity to take advantage of growth as well as providing stability during volatile times. You'll notice when compared to the benchmark S&P 500 on the right, VOO is more or less the same in terms of distribution of sectors and weights. Now, the one thing I'm not a huge fan of when it comes to the S&P 500 in general is that the top 10 holdings make up 22.7% of the overall ETF. This means that 10 out of 508 stocks account for nearly a quarter of your performance, which can be seen as risky by some. However, one thing to note is that these top 10 holdings can and do change over time as these companies continue to gain or lose value to their market cap. The higher the market cap value of a company is in the stock market, the higher weight it's going to have in the S&P 500, and as a result, the higher weight it's going to have in VOO. This is why you may have noticed some of the top holdings here in this VOO fund is companies like Microsoft, Apple, and Amazon, which are all close to, if not above, $1 trillion in market cap. The second main reason here is around the dividends. Dividends are relevant and dividends help contribute to your overall investments over the long term. The good news here with VOO is that it does in fact pay a dividend, currently around 1.5% or so. And if you continue to invest in VOO and reinvest those dividends, it will have a snowball effect and help compound over time to provide you even more gains. And really, it makes sense that VOO does pay out a dividend. Like I said, this tracks the 508 largest companies in America. A lot of those companies pay out dividends. So what VOO does here from Vanguard is they pretty much pass on those dividends into investors' accounts like yours. And with this also, as companies continue raising their dividends moving forward, this will also most likely be reflected in VOO as well as they continue raising their dividends as well. Because like I said, it just pretty much tracks those companies and their performance, including their dividends. Here you can see a history of VOO paying out their dividend, consistently raising year over year as the companies within the S&P 500 are also continuing to raise it. The 5-year growth rate is almost at 9%, which is very impressive by any dividend growth metric. Just keep in mind here though that the risks with these dividend payouts is that it is 100% dependent on the underlying 508 companies. This means that if any of these 508 companies cut their dividends, say during a recession, that cut will also be reflected in VOO as well. That being said though, it's very unlikely that dividend aristocrats that are in the S&P 500 will cut their dividends even during the next recession. So more likely than not, if you had to ask me, I would say that VOO will continue paying out a dividend for a very, very long time, if not forever. Now, the third big reason we look at VOO is because it has low cost fees. Now, the biggest drawback with mutual funds previously and now ETFs is that they charge a fee to hold them. VOO does this as well, however, their fee is much lower than a lot of their competitors. The total fee for VOO is around 0.03%, which is an amount they take out from your investment regardless of if your investment has gained or lost value. This is why it's critical to find a product like VOO that has as low a fee as possible. Yet I see so many people invest in ETFs with fees of 0.5% or above. And if you think that 0.5% versus 0.03% is not that big of a difference, take a look here at this comparison, and what you'll see is that we have the exact same amounts invested, the same return rate, 7%, the same investment term of 30 years. However, the only difference is the MER management fees. And you'll notice that over $100,000 has been lost to fees with the 0.5% option versus only around $6,000 lost with the 0.3% option. So now when I put it into the dollar perspective, does it make a bit more sense? You tell me if it makes more sense to pay $6,000 in fees versus $100,000 in fees for the exact same product. I think this right here is a good enough reason for almost any investor to consider switching to VOO just for the management fee savings alone. Now lastly, since this is a fund that tracks the S&P 500, I want to make sure that I show you guys just how closely this resembles the S&P 500 and what kind of gains you can expect with this moving forward. Since inception, VOO has returned 14.02% annually versus the S&P at 14.06% annually in the same time period. This is pretty close. And hypothetically, if you invested $10,000 in VOO at the beginning of this fund back in 2010, you would now have nearly around $33,000 in your portfolio. So it's quite a significant return that this has yielded investors. Keep in mind though, the stock market as a whole has been in a bull market though for the last 10 years, meaning most companies have seen massive returns in their stock price regardless. The data here kind of gives the impression that VOO may continue with 14% annual returns moving forward. However, I believe that this number will actually decrease over the coming years as growth in general globally slows down. Here you can see a better breakdown of the year-by-year performance, and in 2018, we had our first negative year since the fund has been incepted. On average though, the market grows around 7% year over year historically, so the years of 20% and 30% growth that you see here in this table is pretty uncommon, and you shouldn't be expecting this kind of return every single year moving forward. That being said though, here is the original S&P 500 SPX from inception. And you can see that even though we've had years of negative performance, overall the index is up 2,700%. This just goes to show you that if you just buy and hold, continue averaging in over time, and let your investments grow with time, you can also benefit greatly from this with massive gains over the long term. And really, when you look at these three things that we discussed today, the broad market exposure and diversification, the dividends that are paid out, and the low cost fees, I think that VOO is the no-brainer option for any new investor looking to get started in the stock market who wants to have stability and safety, yet have the potential to gain around 7% on average year over year. Now, if you disagree or agree with me with VOO being the best index fund for 2019, let me know in the comment section down below. I know VTI is another common one people love to look at, but my personal preference is VOO. But if there's any others out there, just let me know. I'd love to know in the comment section down below. And if there's any new ones that I haven't come across, I'll actually go ahead and pin that comment as well. Thank you so much for watching, guys. I hope you enjoyed this video. Hope you found some value in this video. Again, if you're new here, hit that subscribe button down below because we're making a lot more videos like this, which will help you gain financial freedom much quicker while saving you money on things like management fees or any other fees that these companies charge you, so you can maximize your profits moving forward. Thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one. Peace.